What should investors be worried about in 2014? I'm Jack Otter, editor of BARRON'S.com. I'm here with Felix Zulauf, who is the chairman of Zulauf Asset Management and also, of course, a longtime member of the Barron's Roundtable. So give us the big picture view of the world, if you will. You see a lot of reasons to be worried about the U.S. stock market right now, including valuation.
Well, stock markets around the world, in the industrialized world, have gone up a lot last year, and they are all very extended. There is a valuation problem with all of them, the most with the US. There is one-sided bullish sentiment, but there is not the normal trigger for a classic bear market accompanied by a recession. I don't see that. I see the risk of some other problems popping up during the year. One could be a problem in China, where there is a funding crisis. You see that last December and also in June. Short-term interest rates in China popped up very quickly, and it was not because the Central Bank of China tightened. It was because there is funding stress due to the credit boom and investment boom, etc., etc. So I think something there could go wrong, and then you could have a panic in the market and a sell-off of 10 to 20% very quickly, a few weeks' time, very similar to what happened in 97 or 98 market crisis. During that situation, you have to be short stocks. You should own some treasury bonds, 10-year treasury bonds, for maybe the next 6 to 9 months. And you can also buy gold again, because gold is pretty washed out and should recover as panic and risks go up.
Sentiment certainly is negative in gold at this point.
Oh, it's completely washed out. And you have one buyer that really took all the stuff during the whole decline. That was China, and the Chinese are going to continue to buy. They basically bought the whole global production last year. So when the Indians come back, and there will be elections, and the potential candidate is very business-minded, and he wants to help the jewelry business, and he probably reduces import taxes, etc., etc. So the Indians may come back, and then you have some problems and panic in the markets. So altogether gives you a bullish mixture for gold.
Now, meanwhile, this correction that you foresee, you do think that's really a correction. It's not an end to the great bull market. It's more a decline, and then maybe even a short-term buying opportunity?
I really do not know. I assume that we will go higher thereafter, but we will decide once the washout is over, and then go in. I think we could easily go to around 1600 in the S&P, and there I would be a buyer, and then decide on the ensuing rally what to do with the stuff we bought.
Okay. Meanwhile, you have a couple of markets that you're particularly negative about. You've already alluded to China.
Yeah, China is a problem. We do believe that there is going to be funding stress, there is going to be rising interest rates, and it will affect the Hong Kong banking system. The Hong Kong banking system is very exposed to the credit bubble in China. They are exposed on the order of about $400 billion US counter value, and that is about 125% of Hong Kong's GDP. So it's huge. The second largest is the UK, which is only 8% of UK's GDP. So it's huge. And if something happens on the interest rate side, we believe interest rates in the Hong Kong dollar will also go up, because they have to peg to the US dollar, and they cannot devalue and let their currency go down. They will defend it, because it served them well, and if that happens, interest rates go up and stocks go down. And one way of playing that is by selling short the MSCI Hong Kong stock market ETF, which is EWH. Another opportunity we see, and I recommended in the media round barrel last year, is selling short the Turkish lira against the US dollar.
It's already been a tough market in Turkey.
I recommended it at 180, 188 in mid-year. We are now at 216, but the situation is very, very explosive. You have a situation where the current account deficit is $60 billion, so they need the funding of $60 billion. Then you have the corporate sector that is net short indebted in US dollars on the order of $125 billion within maturities of up to 12 months only, and another 32 billion that is a little bit longer than 12 months. So the Turkish corporate sector is essentially short US dollars, and as the dollar goes up and the Turkish lira goes down, they have to run for cover. And that's why it creates tremendous demand. And the foreign exchange reserves of the Turkish central banks are less than 40 billion, which pays for less than 2 months of imports. So eventually they have to let the currency just go. And then it could be very, very explosive. And we are now at 216, and I expect that to go much higher.
Thanks very much, Felix.
You're most welcome, Jack.